Welcome. My name is Nicholas Steele. I'm here with Christopher Carenti, Mary Stennerson, and Drew Milrangani, and today we're going to be presenting on Marriott International. Our agenda today consists of the first three parts being a historical analysis with an industry and strategy analysis, an accounting analysis, and a financial analysis, then moving on to parts 4, 5, and 6 with a prospective and valuation analysis and a recommendation. So moving directly into the industry and strategy analysis, we utilize Porter's 5 Forces model to analyze the hotel industry. Overall, we came to the conclusion that it's not a very attractive industry for new entrants, but it is feasible for long-term success for the existing competitors. The threat of new entrants is fairly low, given that there are a lot of high fixed costs and a saturated market, with those initial overhead costs causing a lot of inhibitors to establish property development. As far as threat of substitutes go, it is low relatively, and it has a medium component, given that there are some Airbnb and home share options recently emerging in the market. However, the primary hotel industry does have an established saturation within the market, and there is a dependence on that level of service. The bargaining power of suppliers is relatively low, given that the suppliers are primarily consisting of labor and trained personnel, and most of the property development management is done in-house. The bargaining power of buyers, on the other hand, is relatively medium given the consumer differences based on varied reservation rates for business travelers versus leisure travelers. And as we mentioned, there's a threat of existing rivalries given those established international firms with a healthy competition based on a higher proportion of fixed costs as opposed to variable costs. Moving on to Marriott's strategy and operations. Marriott operates with a needs-based positioning and differentiation strategy consisting of loyalty programs that allow for certain economies of scale, both globally and in the United States, as well as brand differentiation to address those different consumer types as mentioned before. These include Ritz options versus the Marriott Courtyard. And moving into operations, there's some franchise models and managed hotels instead of owned properties. And this helps mitigate risk, including one of the more recent risks that occurred in 2018, which was a 2018 data security incident that had some reputational ramifications going forward that they would like to fix, which is also leading into why Marriott has begun some sustainability efforts to kind of regain that customer and consumer confidence. Then moving into a description of some comparable companies, Hyatt and Hilton both own and lease a similar amount of properties and franchise certain ones. They also have similar sectors for with respect to different upscale and luxury offerings. They have similar fee structures, loyalty programs, and both operate domestically and internationally.
And now we're going to go over some historical and accounting analysis. So to start, we'll look at some potentially misstated counts within the income statement. As you can see, those are listed in the light blue towards the bottom of the screen. So one of these reasons for these misstatements is managers are incentivized by compensation to put SG&A costs into reimbursable expenses, which then understates SG&A and overstates reimbursable expenses. Additionally, Marriott has a very complex loyalty program recognition system, which may confuse employees and cause them to accidentally misstate revenues. Similarly, this is heightened by the fact that Marriott has a material weakness in their audit controls due to them having laid off a significant portion of their internal auditors due to the COVID pandemic. Moving on to their balance sheet, Marriott's brand name under their intangible assets is likely overstated because the company never went through any efforts to amortize their brand name in light of the COVID-19 pandemic. In order to adjust these accounts, we recommend reallocating some reimbursable expenses to SG&A, lowering the brand name asset, and correcting internal weaknesses through hiring more auditors to correct those internal errors. As a disclaimer, though, we do not have access to any of these numbers as they are very personal to the company, so we will not be including any of these potential adjustments in our forecasts.
Moving on to part 3, it is a historical financial analysis. Starting off with key drivers of financial performance, the first key driver that we looked at was the revenue per available room, or RevPAR, which is calculated by dividing room sales for comparable properties by room nights available for the period. This is a meaningful indicator of Marriott's performance because it measures the period over period change in room revenues for comparable properties. Another key driver we looked at was occupancy, which is calculated by dividing occupied rooms by total rooms available, including the rooms that were temporarily closed due to COVID. As you can see from the RevPAR graph on the right and the occupancy graph on the left, both decreased from 2019 to 2020, with Marriott's properties in Europe having a larger decrease, and this was all due to the COVID-19 pandemic. Next, we analyzed Marriott's performance over time. We started with a simple DuPont ROE decomposition. As you can see, from 2017 to 2018, Marriott's profit margin was increasing, but took a dip in 2019 and 2020 due to the significant impact that COVID had, which increased their expenses and decreased their revenues. Their asset turnover was relatively constant from 2017 to 2019, but then fell in 2020, mostly due to the COVID pandemic and the negative effect that it had on Marriott's revenues. Next, their financial leverage has been increasing since 2017, and this is mostly due to the decrease in shareholders' equity, which was caused by increasing their treasury stock. Overall, Marriott's ROE has been negative 62.09% in 2020, 181.08% in 2019, 85.71% in 2018, and 40.73% in 2017. We also use 3 industry-specific ratios to show how Marriott is performing over time, which were RevPAR, occupancy, and average daily rate. Marriott's RevPAR and ADR were steadily increasing before COVID hit, which caused a dramatic reduction in their RevPAR and ADR, which you can see in 2020. Pre-COVID, Marriott's occupancy was relatively constant as well, but dropped by half due to COVID. Also, Marriott's sales growth, SG&A over sales, and ending net PP&E over sales were all relatively constant pre-COVID, but took a negative hit when COVID occurred at the end of 2019 into 2020. Now we are comparing Marriott with Hilton and Hyatt. All 3 companies are have an asset-light business model, which means they focus on managing or franchising hotels rather than owning them outright. They also all have domestic and international properties, with Marriott having about 72% of their managed and owned properties in the United States, where Hyatt has about 69% and Hilton has about 73%. They also have all expanded their franchising beyond hotels to their co-branded credit cards with large banks. They also have very similar accounting policies. And for example, they all charge similar fees for their managed properties by using a 2-tiered fee structure that consists of a base management fee and an incentive fee based on profits of the hotel. There is one difference in their accounting policies, and that is that Hilton accounts for reimbursements of costs for managed properties under other revenues from managed and franchise properties, while Marriott and Hyatt account for it under cost reimbursement revenue. Lastly, we performed a simple ROE decomposition, RevPAR, occupancy, and ADR analysis of all 3 companies. Marriott and Hilton have similar margins, but Hyatt is higher than both of them. All 3 companies have similar asset ratios, with Marriott having the highest. Marriott and Hilton have similar leverage ratios, but Hyatt has significantly less leverage. And overall, Marriott and Hilton have very similar ROE, while Hyatt has a lower ROE than both of them. Lastly, Marriott, Hyatt, and Hilton all have relatively similar RevPAR, occupancy, and ADR, which highlights the competitive nature of the hotel industry.
And now we're going to talk a little bit more on prospective analysis. So our forecast horizon is over 10 years and is valued as of May 11th, 2021. We are assuming that there will be both growth in the hotel industry and the market as a whole, beginning in late 2021 due to the subsidization, due to the COVID-19 pandemic subsiding. Similarly, we are predicting that the hotel industry will experience setbacks within their luxury and upscale hotels. So this will prevent Marriott from growing too much right at the beginning of late 2021. Now to look at the income statement, as you can see, Marriott has a net income in 2021 of $975 million. If you look at their general administrative and other expenses and then their reimbursed expenses, you can see that the SG&A is significantly lower, highlighting those possible misstatements that we mentioned earlier. Here you can see the balance sheet. Similarly, if you look under intangible assets at brands, you can see that it's relatively high compared to the intangible assets as a whole, which also highlights the possibility for a misstatement mentioned earlier. Here we can see the statement of cash flows. And if anyone would like to examine these statements in further depth, they will be present in our paper that will be accompanying this presentation. Here we can take a look at the forecast assumptions, key ratios that we used. We decreased COGS over sales and SG&A over sales, just as some examples. And similarly, we had increasing sales growth and ROE, showing that Marriott is a cash cow company.
Moving on to part 5, which is our valuation analysis. First, we estimated the cost of equity capital by using the CAPM equation and assuming an average market return of 10% and a risk-free rate of 2%. We also assumed a beta of 1.5, which led us to a cost of equity capital of 14%. We determined that the Marriott's beta was going to be 1.5 because their current beta is around 1.88, as you can see from the graph on the left. And this is mostly due to the uncertainty of the hotel industry in COVID times, because pre-COVID, Marriott had a beta of around 1.3. So we assume that once COVID is over, Marriott's beta will drop back down. And because of this, we are only using one discount factor for our entire valuation, we have decided to assign Marriott's beta between its pre and post-COVID betas. Here is a screenshot of our residual income model valuation, which gives us a share price of $46.38. This is a picture of our discounted cash flows valuation, with the top portion showing how we derived our free cash flow to common equity, and the bottom portion discounting all those free cash flows back, which gives us a forecasted price of $46.38. Moving on to our sensitivity analysis. Our first sensitivity analysis we did was if sales don't return to pre-COVID levels immediately, and we did this by decreasing our sales growth, which led to a new stock price of $38.10. Our second sensitivity analysis was if sales are better than we had estimated, and we did this by increasing our sales growth, which led to a new stock price of $122.50. And our third sensitivity analysis was cost of goods sold over sales stays high due to people wanting to keep the COVID-19 procedures in place. And we did this by increasing our cost of goods sold over sales, which led to a new stock price of $27.31.
Moving on to part 6, our recommendations. Based off of the valuation, we derived the previous parts. Our forecasted stock price for Marriott International is $46.38. This was third of the actual price, $146.69, at which the stock last traded. Given these statistics, we recommend all investors to sell Marriott International because there exists no margin of safety for an investor given its intrinsic value and current pricing. The graph here is taken from an analysis done by Guru Focus. It depicts the actual stock price over the years in blue versus their prediction on Marriott stock price in black. The red and green zones represent the margins of error. Our forecasted price is in pink and ideally within the green safety margin, which we consider a reasonable price to buy Marriott at. However, the actual stock price is well beyond the margin of error for Guru Focus. This might be a good indication of a market correction likely to undergo as investors realize these discrepancies among stock price and stock value. We suggest it might be a good time to short the stock and make some bank. On analyzing the markets further, we conclude two big reasons for the overvaluation of Marriott stock. First, we think the market as a whole is overvalued. The 10-year PE ratio for the market is 37.7 currently, a number which is 91% above modern era market average, showing resemblance to the 2000s internet bubble, where the number was 132% above market average. Second, the over-optimistic expectations of investors for the hotel industry to revert back to pre-pandemic level profitability, which we think is highly doubtful given the increasing favorability of substitutes like Airbnb and Vrbo in the market. Finally, we would like to readdress the possible inabilities of our analysis. There were a few dead ends that we saw while doing the accounting analysis. We could not find ample data on some numbers in the financial statements. For example, we did not know how much reimbursable expense should be moved to SG&A, nor did we know how much to amortize their brand name by due to COVID-19. On the evaluation part, Marriott's line items did not match up with the eval software that we used to forecast. So we had to condense and decondense line items to make them compatible with the software, leading to some possible errors. Evaluation could also have been more accurate if we could find a more accurate beta for the stock to use in the CAPM model, but given the sudden impact of the pandemic and the market volatility, it was difficult for us to come to a consensus about the beta from Marriott. And likewise, no one knows what the future looks like and whether or not we will ever be able to free ourselves from pandemics down the line. Thank you.